Imagine stepping into a boardroom. Right.
Okay.
You're looking your investors dead in the eye, and you tell them that you plan to intentionally lose $16 billion this year.
Yeah, just on a single research project.
Exactly, on one project. And then, imagine telling them that this massive hemorrhage of cash is actually, like, going exactly according to plan.
And that they should be thrilled about it.
Right, they should be thanking you. Well, today we are doing a deep dive into the source material that basically outlines exactly that. We are opening up the hood on Meta Platforms, Inc.
Specifically looking at their Q1 2026 Form 10Q financial filing.
Yeah, the 10Q. And, most people see a corporate spreadsheet and their eyes just completely glaze over.
Oh, absolutely. It's just a wall of numbers.
Right. Numbers, legal jargon, accounting codes, all of it. But when you actually decode the document we're looking at today, it doesn't read like an accounting report at all.
No, it really doesn't.
It reads like the blueprint for a corporate empire, one that is trying to literally buy the physical future of human computing.
While simultaneously, fending off these massive existential attacks from almost every major government on the planet.
It's wild. The contrast within these pages is just stark.
It really is. We are analyzing a snapshot of a company existing in a state of, absolute dual extremes.
Right.
Because on one hand, the financial velocity here is staggering. We're talking about a 33% increase in revenue year over year.
33%.
Yeah. They are printing money at a rate that, frankly, defies traditional economic gravity.
But then on the flip side...
Right. On the other hand, the friction they are experiencing is completely unprecedented. They are fighting multi-front, multi-billion-dollar wars with global regulators.
The IRS.
The IRS, yes. And honestly, they're fighting the physical limitations of the global power grid itself.
Which is just crazy to think about. And so that is the mission of our deep dive today. We are not just going to sit here and read a list of assets and liabilities.
No, that would be incredibly boring.
Right. We are going to unpack the fascinating, the hidden machinery of one of the world's most powerful entities. We want to deconstruct exactly how Meta generated $56.31 billion in just 90 days.
90 days. It's a staggering number.
And we'll explore the incredibly secretive ways they are burying literally hundreds of billions of dollars into future infrastructure projects.
Yes, the physical build-out.
And of course, we have to examine the legal avalanches that are threatening to fundamentally alter or even, break apart their entire ecosystem.
It's essential to look beyond the corporate veil here. This filing isn't just a status update on a tech company.
Right. It's bigger than that.
It's a highly detailed map of the modern digital economy. The mechanisms described in this 10Q, they basically dictate the flow of global information and commerce.
Which brings me directly to you, the listener. Because, you are the fuel for this entire machine.
Exactly.
Every single time you scroll through Instagram while you're, waiting for a coffee, every time you pause for half a second on a targeted ad for a new jacket.
Every WhatsApp message you send.
Yeah, every message. Every time you read a headline about the latest leap in artificial intelligence, you are actively participating in the exact ecosystem detailed in this document.
Your attention is the product.
Your attention, your behavioral data, your micro habits, they are the raw materials being processed, refined, and ultimately monetized in these spreadsheets.
And understand the mechanics of that conversion. How your passive scrolling is engineered into billions of dollars of capital, and then how that capital is deployed to shape the literal hardware of the next decade.
Right.
That is arguably the most crucial literacy for understanding how the modern world actually functions.
I completely agree. So, before we can even begin to talk about how Meta is spending its money to build the future, we have to look under the hood of the engine that is generating all that cash right now.
The profit engine.
The profit engine. And the numbers for the first quarter of 2026, they're difficult to fully comprehend without breaking them down. Total revenue came in at $56.31 billion for just the first 3 months of the year.
Yep.
And the net income, the pure profit after all the bills are paid, that was $26.77 billion.
Let's contextualize that profit margin for a second. Generating almost $27 billion in net income in a single quarter.
It's absurd.
It means they're clearing roughly $300 million in pure profit every single day.
Every day.
Every day. That is the kind of cash generation that rivals, or honestly exceeds, the peak historical profits of the largest oil conglomerates.
But instead of oil.
But it's being generated entirely by the buying and selling of human attention.
And the scale of that human attention they're capturing is just staggering. The document details their daily active people, or DAP, across what they call their family of apps.
Right, which includes Facebook, Instagram, Messenger, and WhatsApp.
Yeah. That number hit 3.56 billion in March 2026. I mean, nearly half the population of Earth is logging into this ecosystem every single day.
Unprecedented scale.
And their average revenue per person globally hit $15.66. But here is the specific data point that really caught my eye and where I need you to break down the mechanics for us.
Okay, lay it on me.
Their total ad impressions grew by 19%, but the average price per ad grew by 12%.
Right.
Okay, let's unpack this. Because in any normal market, right, if you massively increase the supply of a product, like in this case showing 19% more digital billboards to users,
Its price should go down.
exactly, the price for that product should drop. But Meta somehow built way more digital billboards and managed to charge advertisers 12% more for the rent on every single one. I mean, how does the basic law of supply and demand seemingly not apply here?
It's a really brilliant observation, and the answer lies entirely in how they have re-engineered the nature of the billboard itself.
Okay.
So, for the past several years, the entire digital advertising industry has been fighting a massive headwind regarding privacy.
Oh, right, the Apple thing.
Exactly. Operating systems, most notably Apple with their iOS updates, fundamentally changed the rules of data tracking. They made it incredibly difficult for apps to follow you around the internet, from website to website, to build a profile on your buying habits.
That's the whole ask app not to track button.
Yes. Historically, if an advertiser couldn't track you across the web, they couldn't serve you a hyper-personalized ad. And if the ad isn't personalized, if I show an ad for dog food to someone who only owns cats,
That ad is useless.
it's drastically less valuable. So advertisers bid less, and the price per ad drops.
Because the advertiser is flying blind. They aren't going to pay a premium if they don't have absolute certainty that the person looking at the screen has a high probability of actually clicking the buy button.
That is the traditional model, exactly. Now, Meta's solution to this, which is explicitly detailed in their filing, was to essentially build their way out of the problem using artificial intelligence. They state that the increase in the average price per ad was driven directly by advertising demand, fueled by ongoing improvements in ad performance from their AI targeting and measurement tools.
So they don't need the Apple tracking anymore.
Right. Rather than relying on a cookie following you from a shoe store website back to Instagram, they are using generative AI and advanced predictive models to guess what you want, based purely on your behavior within their closed walls.
Oh, wow.
They are analyzing how long your thumb hovers over a video. They look at what kind of accounts you message, the cadence of your scrolling.
So they're essentially doing complex behavioral math. Like, even if they can't see what I do on the rest of the internet anymore, the AI is smart enough to deduce my interests just by how I interact with the app itself.
Exactly. Furthermore, they are actively changing the format of the ads to keep you inside their ecosystem entirely.
How so?
Well, they are aggressively pushing click-to-message ads. So clicking an ad opens a chat with the business directly in WhatsApp or Messenger.
Right.
By doing this, the entire transaction, from initial impression to customer service to the final sale, it all happens on Meta's servers.
So they don't lose sight of you.
They regain total visibility, which means they can definitively prove to the advertiser that the ad worked. And when you can prove a return on investment using AI measurement tools, advertisers are more than willing to pay that 12% premium, even as the total volume of ads increases.
I see the logic there for places where people are relatively free to be tracked within the app. But let's look at the geographical breakdown of this revenue, because this is where the filing gets really surprising to me.
Okay, let's look at it.
So US and Canada revenue grew 29%. Asia Pacific grew 29%. The rest of world category grew 40%, but Europe grew by 39%.
Yes.
And I follow European tech regulation pretty closely. The European Union is arguably the most hostile regulatory environment on the planet for data brokers right now.
Oh, undoubtedly.
Right. Between the GDPR and the new Digital Markets Act, the EU is actively trying to strangle behavioral tracking. So how on earth is Meta squeezing a 39% revenue increase out of a region that is doing everything legally possible to block their core business model?
The 10Q provides an absolute masterclass in regulatory adaptation regarding the European market.
Do tell.
So the European Digital Markets Act, or DMA, it forced a structural change in how Meta operates. Historically, Meta justified collecting your data by claiming a, quote, legitimate interest in providing a personalized service.
Which regulators hated.
Right. The European Commission ruled that just wasn't good enough for behavioral advertising. They mandated that Meta must explicitly ask for and receive active consent from the user to process their data for these purposes.
Which, I mean, that's a terrifying prospect for an ad company. If a pop-up asks, hey, do you want us to meticulously track your behavior to sell you things? A massive percentage of the population is going to hit no.
That was the expectation, yeah. To counter this, Meta introduced a binary choice in Europe, the subscription for no ads model.
Right.
If a user is fundamentally opposed to their data being used to serve ads, they can pay a monthly fee to use Facebook and Instagram ad-free. It essentially puts a direct, literal price tag on privacy.
But the vast majority of people are not going to pay a monthly fee for something they've used for free for a decade. I mean, they are going to choose the free tier.
They do. But for the users who choose the free tier and still refuse to give active consent for highly personalized tracking, Meta launched a fallback mechanism. They call it less personalized ads, or LPA.
Less personalized ads, okay.
The filing is very transparent about this. LPAs rely on significantly less data. Perhaps just basic contextual clues, like your general location or the broad category of the content you are currently viewing, rather than your deep historical profile.
But by definition, those ads are a worse product. I mean, they're less targeted, which means the advertiser gets a lower return on investment.
You're right, and the filing acknowledges that these LPAs are less effective for advertisers. However, the fact that European revenue still spiked 39% reveals a multi-layered reality here.
Okay, what's happening?
First, the pricing power Meta commands through its AI targeting on the users who do consent is phenomenally strong.
So they make up for it there.
Right. Second, the sheer volume of ad impressions being forced through the system is compensating for the lower quality of the LPA tier. They're just showing more ads.
Quantity over quality.
Exactly. And third, the document points out that the online commerce vertical, advertisers selling physical goods directly through the platforms, that was the primary driver of growth globally.
Right.
Retailers are finding that even in a fractured regulatory environment, Meta's scale is just unparalleled.
Speaking of that scale, let's test it against the numbers they are claiming. They state their daily active people is 3.56 billion. I really have to push back on how they actually calculate that because human behavior is messy.
It is very messy.
Right. Like I have a personal Instagram account, I have a separate account for my dog, I have a Facebook account I log into maybe once a year, and I use WhatsApp every single day.
A very common setup.
Am I 4 people in this spreadsheet? Because if I am, that 3.56 billion number is vastly inflated.
Meta anticipates that exact skepticism, and they actually dedicate significant space in the footnotes to explaining their methodology. They do not report total registered accounts.
Okay.
They utilize highly complex machine learning models to identify and link multiple accounts back to a single human entity.
Wait, really?
Yeah. They look at a massive web of signals, the unique identifier of your mobile device, your IP address link in your phone and your laptop, the similarity of the names on the accounts, and overlapping behavioral patterns.
Wow.
They take your dog's Instagram, your dormant Facebook, and your active WhatsApp, group them all together, and count you as one single daily active person.
That implies a level of surveillance that is almost invisible. Like, they know the dog account is me, even if I never link them explicitly, just by analyzing the invisible digital exhaust of my devices.
Exactly.
But even with that sophisticated AI, it can't be flawless.
It isn't flawless, and the 10Q explicitly outlines the limitations. They disclose an estimated margin of error of approximately 3% globally for these family metrics.
3%.
Yes. Furthermore, they have to constantly scrub the data for what they call violating accounts. These are the bot farms, the spam rings, the entirely fabricated profiles that plague any open network.
But still, 3% of 3.56 billion is over 100 million people. That's a massive margin of error. And what about the bots? What percentage is that?
Regarding violating accounts, Meta estimates that less than 5% of their worldwide daily active people consist purely of these fake profiles. Interestingly, they note they updated their methodology in late 2025 to focus more heavily on recent account activity to catch these networks faster,
Ah, okay.
which is why they're confident the number sits below that 5% threshold.
Even with that confidence, if you dig into the very granular regional data tables in the filing, there is a fascinating anomaly. The daily active people actually experienced a slight decline in the first quarter of 2026.
Yes.
If the AI is so good and the revenue is up 33%, how does the actual human user base shrink?
Well, that slight decline highlights the one variable even Meta's AI cannot control, and that's geopolitics.
Geopolitics.
The 10Q specifies that the drop in DAP was not due to a loss of interest in the product, but rather two distinct state-level interventions. They point to severe internet disruptions implemented by the government in Iran and strict limitations placed on WhatsApp access in Russia.
That is wild to think about. The only force powerful enough to actually dent the growth chart of this platform is a literal nation-state level shutdown of physical internet infrastructure.
It demonstrates the vulnerability of operating a truly global communications network, but it also sets up a crucial economic reality for the listener to grasp regarding their own value in this system.
Okay.
We mentioned earlier that the average revenue per person was $15.66 globally. That money is not distributed evenly.
Let me guess. An advertisement shown to someone sitting in New York is worth exponentially more than an ad shown to someone in a developing market.
The disparity is vast. If we look at the raw revenue generation, the United States and Canada generated over $21 billion for the quarter.
Wow.
The rest of world category, which encompasses a vastly larger population of human beings, generated just $6.3 billion.
That's a huge difference.
The entire economic architecture of this company relies disproportionately on the high-value consumer markets of North America and Europe. If you are a listener sitting in one of those regions, your attention, your disposable income, and your behavioral data are the premium commodities that are keeping this engine running.
Which transitions us perfectly into this central mystery of this entire financial document. Because when a machine generates $26.77 billion in pure profit in 90 days, the immediate question is, well, what do you actually do with all that cash?
You have to put it somewhere.
Right. You don't just leave it sitting in a corporate checking account. You don't put it in a money market fund. You deploy it. And looking at this filing, they are deploying it to build a physical Leviathan.
The transition detailed in this 10Q from abstract digital software profits to heavy physical concrete and steel infrastructure. I mean, it is arguably the most significant strategic pivot in modern corporate history.
Let's look at the capital expenditures, or CapEx. This is the money a company spends to acquire, upgrade, and maintain physical assets. Land, buildings, servers, stuff like that.
Right.
For this single quarter, their CapEx was $19.84 billion. They spent nearly $20 billion in 3 months on physical objects.
Incredible.
But alongside that number is another statistic that feels almost contradictory. Their total headcount, the number of actual human beings they employ, only grew by 1% year over year. They currently employ 77,986 people.
The juxtaposition there is key.
Wow.
A $20 billion quarterly capital expenditure against a mere 1% growth in human headcount tells the entire story of Meta's future.
How so?
It illustrates a definitive structural shift from investing in human capital to investing in machine capital. Think about it. 10 years ago, if a tech company wanted to grow its revenue by 33%, it had to hire thousands of new software engineers, product managers, and sales teams.
Right, huge hiring sprees.
Today, Meta doesn't need legions of new coders. They need legions of highly advanced, specialized microchips to train their artificial intelligence models. The labor force is basically transitioning from organic to silicon.
And the scale of the silicon they are purchasing is largely hidden in the back half of the 10Q.
Oh.
It's buried in the footnotes about future obligations. The filing reveals that Meta has $182.88 billion in what they call uncommenced leases.
Yes, uncommenced leases.
These are legally binding contracts for massive data centers, co-location facilities, and dark fiber network infrastructure where the lease terms haven't even officially started yet. And they stretch out to 2036.
A decade out.
Furthermore, they list $237.67 billion in non-cancelable contractual commitments, the vast majority of which is dedicated to third-party cloud capacity and specialized servers. And here's where it gets really interesting. I was digging through the section on non-marketable equity investments, which, usually just lists minor stakes and small startups. But there is a massive multi-billion-dollar project buried in there.
Ah, the Louisiana project.
Oh. Yes. It details a joint venture for a massive data center campus in Louisiana. But the way it is structured financially is bizarre. Why wouldn't a company with tens of billions in cash just buy the land and build the data center themselves?
Because of the immense scale of the financial risk and the desire to optimize their primary balance sheet. The Louisiana project is structured as what accountants call a variable interest entity, or a VE.
IVI.
Right. In October 2025, Meta entered into an arrangement to co-develop this site. But crucially, Meta only holds a 20% membership interest in the actual venture entity.
Wait, if they only own 20%, who owns the rest? And why is Meta taking point on it in their own SEC filing? I really need you to explain this VIE concept because it sounds incredibly opaque.
It is opaque by design. A variable interest entity is a highly sophisticated piece of financial and legal architecture. Let's use an analogy to make it clear.
Please.
Imagine you want to build a sprawling $50 million mansion, but you don't want a $50 million liability sitting on your personal credit report, dragging down your borrowing power.
Makes sense.
So you create a separate legal trust. You only put in 20% of the money to fund the trust, and outside investors put in the rest. However, you sign an airtight contract with that trust, guaranteeing that once the mansion is built, you will be the sole tenant and you will pay an exorbitant rent for the next 20 years.
Okay, I'm following.
Because you don't have the majority voting rights in the trust, the massive debt to build the mansion doesn't sit on your personal balance sheet. It belongs to the trust. But functionally, you control the economic destiny of the property.
So they are essentially co-signing a massive mortgage for a project they technically only own a fraction of, just to keep the raw debt off their main books.
Exactly the mechanism. The 10Q states that the parties involved have committed to fund their pro rata share of approximately $27 billion in total estimated development costs for this single Louisiana campus.
$27 billion for one campus. Right. And Meta only owns 20%. Because they theoretically do not have the power to direct the activities that most significantly impact the venture's economic performance, they do not consolidate this massive $27 billion entity onto their primary financial statements. It just sits off to the side, siloed away.
But if it's off to the side, how is Meta guaranteeing they actually get to use the servers once they're built?
Through the leaseback agreements and something called residual value guarantees, Meta has agreed to lease back the right to use the properties on this campus starting in 2029. With an initial lease commitment of $12.31 billion.
Okay.
Furthermore, the 10Q notes they have provided residual value guarantees, or RVGs, with an aggregate threshold of approximately $28 billion.
Let me make sure I understand the RVG. Using our mansion analogy, is this the equivalent of me legally promising the bank that if I ever move out of the mansion, or if the local real estate market crashes and the mansion loses its value, I will personally pay the bank the difference out of my own pocket? Up to a certain limit. That is precisely how an RVG functions. If Meta decides to terminate the lease, or if the technological landscape shifts and those specific data centers become obsolete and lose their fair market value, Meta is legally on the hook to make the venture whole, up to that $28 billion threshold.
Wow.
So they have successfully decoupled the immediate asset and the direct construction debt from their quarterly balance sheet, which pleases Wall Street. But they simultaneously absorb almost all the long-term financial risk to guarantee their access to the facility.
That is an unbelievable level of financial engineering just to build a data center. But, I mean, it forces a larger question. Why undergo this extreme acrobatics? Why lock up nearly $250 billion in non-cancelable hardware commitments and orchestrate $27 billion off-the-books construction projects? What are they building that requires this much raw power?
The filing is quite explicit about the motivation. Meta states that these ventures provide, quote, strategic optionality and flexibility, which we expect will enable us to effectively meet future infrastructure capacity needs as AI markets and technologies develop.
So it's all AI.
Yes. This entire physical build-out is in service of one goal: dominating the era of generative AI and reaching what their leadership terms artificial general intelligence, or superintelligence.
You know, people hear AI and they just think of software. They think of a chatbot on their screen typing out a recipe. They don't think about concrete.
And that is the great illusion of the cloud. The cloud is not ethereal. The cloud is heavy industry.
Right.
Training a next-generation, multi-trillion parameter AI model requires a level of physical computing power that is historically unprecedented. We are not talking about a few racks of servers in a closet. We are talking about facilities the size of multiple aircraft carriers, packed wall-to-wall with highly specialized GPUs.
And those chips run hot.
Very hot. They generate so much heat that traditional air conditioning is totally useless. They require massive industrial liquid cooling systems just to prevent the silicon from literally melting.
Hmm.
And driving those chips in those cooling systems requires unimaginably massive amounts of electricity.
So when Meta locks up $237 billion in hardware and signs uncommenced leases out to 2036, they aren't just planning for normal user growth. They're trying to aggressively buy up the global supply chain of computing power before their competitors can.
They are establishing a physical moat. If the future of the economy is built on AI, the winner might not be the company with the cleverest algorithm. The winner will be the company that physically possesses the concrete facilities, the cooling infrastructure, and the contracted gigawatts of electrical grid power required to run the math.
And they're buying the grid.
Exactly. Meta is using the cash generated by their ad engine to quietly buy the physical grid of the future.
Which brings us to the other massive sinkhole for that ad revenue. Because if the data centers and the cloud commitments represent the hidden foundational backend of Meta's future, then their Reality Labs division is the highly visible, incredibly expensive consumer-facing front end.
Yes, Reality Labs.
And the financial contrast between the two sides of the company is just, it's almost comical.
The segment reporting in this 10Q lays bare the absolute duality of their operations.
Let's run the numbers real quick. As we established, the family of apps, the digital landlord business, brought in nearly $56 billion in revenue. Reality Labs, which is their hardware division responsible for virtual reality, augmented reality, the Quest headsets, the Ray-Ban smart glasses, Reality Labs brought in a grand total of $402 million in revenue for the quarter.
$400 million against $56 billion.
Right. And to make it worse, that revenue was actually down 2% year over year. But to generate that tiny fraction of revenue, the division operated at a staggering loss of $4.028 billion for the 90-day period.
A $4 billion loss.
I try to conceptualize this, and the only analogy that makes sense to me is that Meta is running the world's most profitable, busiest casino, which is Facebook and Instagram, just so they can take wheelbarrows full of the casino's daily profits and dump them into a furnace next door to fund a sci-fi theme park that currently has almost no visitors.
It is an apt analogy, but it kind of misses the deliberate nature of the furnace. I mean, a $4 billion quarterly loss would instantly bankrupt almost any other corporation on Earth.
Oh, without a doubt.
It would trigger massive shareholder revolts. The CEO would be fired immediately. But in this 10Q, under the specific section titled Investment Philosophy, management calmly writes that they expect Reality Labs' operating losses to continue at a similar or even accelerated pace for the full year 2026.
They're explicitly warning Wall Street, like, we are going to lose $16 billion this year on this hardware division, and we are not apologizing for it. How do they justify that to institutional investors who want short-term returns?
What's fascinating here is how they articulate the timeline. They state that these multi-billion-dollar investments are directed toward long-term foundational research and development for products that, quote, may only be fully realized in the next decade.
The next decade.
Yes, they are not trying to build a gadget that will be profitable by Christmas. They are trying to invent entirely new paradigms of human-computer interaction. Neural interfaces, advanced augmented reality operating systems, holographic displays.
I mean, I understand the ambition. They want to own the next computing platform, so they never have to be subservient to Apple's iPhone rules or Google's Android ecosystem ever again. If they own the glasses, they own the App Store.
Precisely.
But let's look at the actual consumer adoption data buried in the filing. The document notes that the 2% drop in Reality Labs revenue was primarily driven by lower MetaQuest hardware sales. The big immersive VR headsets are slowing down. However, they note this was partially offset by a significant increase in the sales of their AI smart glasses. I feel like there is a profound signal hidden in that specific shift in sales data.
There is, and it is a crucial insight for understanding the trajectory of consumer technology. The diverging sales paths of the Quest headsets versus the AI glasses highlight a massive pivot in what the mainstream public is actually willing to accept.
Right.
Virtual reality headsets, by their very physical nature, demand isolation. They are heavy, they're immersive, and they deliberately separate you from your physical environment and the people around you. They require you to dedicate a block of time to step out of reality.
Whereas the glasses do the exact opposite.
Exactly. The AI glasses, which they have developed in partnership with companies like Ray-Ban, represent frictionless augmentation. You wear them like standard sunglasses, they don't block your vision, they enhance it.
And they have the AI built right in.
Right. They have integrated cameras and AI voice assistants that can see what you're looking at and provide contextual information in real time without pulling you out of the physical world. The sales data proves that consumers are largely rejecting heavy, isolating immersion in favor of lightweight, frictionless augmentation.
So they're just following the data.
Yes, Meta is watching this hardware adoption curve play out in real time on their balance sheet, which is why the glasses are becoming the focal point of their consumer hardware strategy, while the headsets stall out in a niche market.
Okay, so we have mapped out the $56 billion profit engine. We've explored the grand decadal vision for the physical future, spanning everything from massive Louisiana data centers to AI-powered sunglasses. But standing directly between Meta and that meticulously planned future is a sprawling, highly aggressive gauntlet of legal and regulatory threats. And this isn't just standard corporate litigation. We are talking about existential threats to their core business model.
The legal and related matters section of this 10Q is genuinely daunting. It spans pages of highly detailed summaries of investigations, lawsuits, and fines emanating from almost every major jurisdiction globally.
Now, I want to frame this carefully for you, the listener. We are about to discuss legal battles involving the Federal Trade Commission, the European Union, and multiple state attorneys general. These cases touch on highly charged societal issues like antitrust philosophies, content moderation, and the impact of technology on youth mental health.
Right.
Our objective here is not to litigate the morality of social media or to take a political stance on government regulation. We aren't taking sides here. We are looking at these lawsuits strictly through the lens of this financial document as objective material risk to Meta's structural integrity and their balance sheet.
That is the correct analytical approach. From an SEC filing perspective, a lawsuit isn't a moral debate. It is a quantified liability. Our goal is to dissect how these specific legal mechanisms threaten the revenue engine we just spent the last half hour analyzing.
Perfect. So let's start with the most traditional threat, the Federal Trade Commission's ongoing attempt to literally break the company apart.
The FTC antitrust suit.
Right. The FTC filed a complaint alleging Meta engaged in anti-competitive monopolistic conduct by acquiring Instagram back in 2012 and WhatsApp in 2014. They are seeking a permanent injunction that could force Meta to divest or reconstruct those platforms. Now, reading the timeline in the 10Q, it says this specific antitrust trial actually concluded a year ago in May of 2025, and the court granted judgment in Meta's favor. So did they win? Is the breakup threat just over?
They won the battle, but the war is actively continuing. The filing notes that the FTC filed a formal notice of appeal in January 2026.
Yeah.
So the structural threat of a forced breakup remains a looming liability in the appellate courts.
Right.
However, if we look closely at the filing, there is a secondary parallel FTC action that is arguably a far more immediate and dangerous threat to Meta's day-to-day operations than the breakup lawsuit.
You're talking about the privacy consent order?
Yes. Back in 2020, Meta agreed to a massive privacy consent order with the FTC. They paid a $5 billion penalty and agreed to strict oversight. But in May 2023, the FTC initiated a public administrative proceeding seeking to unilaterally modify that existing order. They allege Meta violated the original terms.
And what exactly is the FTC trying to add to the order now? Because the filing lists some demands that seem incredibly sweeping.
The FTC's proposed modifications are draconian from a corporate perspective.
Yeah.
First, they want to impose a blanket prohibition on Meta monetizing the data of minors. They want to ban them from using youth data for anything other than providing the base service, meaning no targeted advertising to anyone under 18.
Wow. That immediately slices off a massively lucrative demographic from their core ad engine. But there's a second demand listed here that seems even wilder to me. The FTC wants to impose limitations on Meta's ability to modify and launch new products.
That is the structural kill switch.
The kill switch.
The government is essentially asking for the power to act as a permanent product manager for Meta. If the FTC have to pre-approve every new algorithm tweak, every new AI feature, or every new hardware integration, Meta's ability to innovate and compete against companies like TikTok or Google would be totally paralyzed by bureaucratic friction.
You'd never be able to launch anything fast enough.
Exactly. Meta is fighting this on profound constitutional grounds, arguing that the FTC's internal administrative structure is legally improper. They are currently locked in a complex maze of injunctions and appeals, waiting on broader Supreme Court rulings regarding agency power. But if the FTC succeeds, it would fundamentally alter Meta's ability to operate as a technology company.
And it isn't just Washington, D.C. coming after them. Across the Atlantic, the European Union is consistently levying massive fines. The 10Q details a €798 million fine regarding allegations that Meta unfairly tied Facebook Marketplace to the main Facebook social network to crush competing classified ad services.
Right.
And there is another €200 million fine directly related to the subscription for no ads model we discussed earlier, with regulators claiming it still violates the Digital Markets Act. But I have to play devil's advocate here.
Go ahead.
When a company is sitting on over $20 billion in cash and generating $26 billion in net income every 90 days, does a €798 million fine actually matter? I mean, is it a deterrent, or is it just the standard calculated cost of doing business at a global scale?
If we connect this to the bigger picture of legal risk, you are correct to be skeptical of the fines. A billion-dollar penalty is a mere rounding error on this balance sheet. It is a temporary dip in the quarterly dividend. The true existential threat to Meta is not monetary. The threat is what the legal system terms structural and behavioral remedies.
Meaning a judge orders them to fundamentally change the actual code of how their app works rather than just cutting a check to the government.
Exactly. And the most vivid example of this behavioral threat is found in the section detailing the sprawling youth and addiction lawsuits. Meta is currently facing a massive multi-district litigation centralized in federal court in California, alongside dozens of parallel lawsuits from state attorneys general.
Yeah, the youth lawsuits.
The core allegation across all of these suits is that Meta deliberately designed Facebook and Instagram with features like infinite scroll and intermittent variable rewards that cause addictive behaviors in minors, leading to severe mental health harms.
The filing specifically highlights a recent trial in New Mexico.
Yes. In March 2026, a jury returned a verdict against Meta in a case brought by the New Mexico Attorney General. The jury ordered a civil penalty of $375 million.
Which, again, financially irrelevant to Meta.
Irrelevant. However, the New Mexico AG is utilizing a highly aggressive legal strategy. They are treating the alleged societal harm caused by the algorithm the same way a state would treat an oil company that dumped toxic waste into a river. They're pursuing what's called abatement costs.
Ah, like the legal mechanism used in the opioid settlements or tobacco litigation. They want Meta to pay to clean up the alleged public health crisis.
Precisely. The state has indicated it intends to seek $3.7 billion in abatement costs to fund mental health resources and treatment programs. But more critically, they are seeking injunctive relief that would force extensive changes to how Meta provides its services.
Behavioral changes.
Yes. If a judge legally mandates that Meta must remove algorithmic feeds for minors or implement highly restrictive age verification systems that require users to upload government IDs, that introduces massive friction.
Right. And people hate friction.
Friction is the absolute enemy of engagement. If engagement drops, ad impressions drop, and the entire $56 billion revenue engine begins to stall. That is the behavioral remedy threat.
And the filing also mentions personal injury lawsuits from individuals, not just governments. There is a note about a California bellwether trial where a jury awarded $6 million in damages to a plaintiff, split 70% to Meta and 30% to YouTube.
A bellwether trial.
Yeah, a $6 million verdict is nothing to them. But it's a bellwether. It proves the legal theory can win in front of a jury. And that leads to the most logistically insane paragraph in this entire document. The 10Q states that following that verdict in November 2024, counsel for over 100,000 individual claimants filed mass arbitration demands.
That's unbelievable.
100,000 individual cases. I mean, how does a corporate legal department even begin to process that volume of litigation?
They don't. It is designed to be a logistical nightmare. Mass arbitration is a relatively recent, highly aggressive legal tactic.
Oh.
In the past, consumers would be grouped together in a massive class action lawsuit.
Right.
But tech companies, including Meta, started writing mandatory arbitration clauses into their terms of service, forcing users to waive their right to a class action and instead settle disputes individually before a private arbitrator.
They thought it would protect them, right? Because nobody is going to hire a lawyer to go to arbitration over a $20 dispute.
That was the theory. But plaintiff law firms realized that under these arbitration rules, the corporation is almost always required to pay the initial filing fees for the arbitration process. So these law firms utilize aggressive online marketing to sign up tens of thousands of claimants simultaneously.
Oh, wow.
And then they dump all 100,000 arbitration demands onto Meta's desk on the exact same day. Even if the filing fee is just $1,000 per case, Meta is suddenly legally obligated to pay $100 million in non-refundable administrative fees before a single shred of evidence is even reviewed.
That is wild.
The strategy is to overwhelm the corporate infrastructure with sheer volume, forcing the company into a massive global settlement simply to stop the administrative bleeding.
Okay, so we have the FTC trying to break them up, the EU rewriting their business model, states demanding billions in addiction abatement, and 100,000 arbitrations clogging the legal pipes. But there's one more category of legal threat buried here that directly threatens their grand vision for the future.
The AI copyright suits.
Exactly. We talked about that $237 billion pivot into artificial intelligence. Well, there's a whole section detailing copyright lawsuits regarding generative AI.
This represents the absolute Wild West of contemporary technology law. Beginning in 2023, multiple putative class actions were filed by high-profile authors, news organizations, and software developers. They allege that Meta aggressively scraped the internet and improperly utilized millions of copyrighted materials like novels, news articles, proprietary code to train their large language models like the Llama AI system.
Which makes intuitive sense. An AI model doesn't inherently know anything. It is a blank slate. To teach an AI how to write a poem or generate code, you have to force it to read billions of examples of poems and code. And a vast amount of that training data was written and copyrighted by human beings who never gave Meta permission to use their work.
The plaintiffs argue that this ingestion process constitutes massive copyright infringement. Meta's defense relies heavily on the doctrine of fair use, arguing that analyzing data to identify patterns and create a transformative new tool does not violate the underlying copyright of the training material.
The filing mentions cases in California and New York involving famous authors like Richard Cadre and Michael Chabon. It notes that Meta did win a partial summary judgment regarding the core fair use defense for the actual training process for some specific claims.
Right, a partial win.
But the litigation is actively proceeding regarding other claims, including how the models distribute information. I want to explore the absolute worst-case scenario here. What happens if a higher court eventually rules that training generative AI on copyrighted books without a license is definitively not fair use?
That is where the financial liability becomes genuinely terrifying for tech companies. In the United States legal system, copyright infringement carries the threat of statutory damages. If a court determines that a company willfully infringed on a copyright, the law allows for damages of up to $150,000 per infringed work.
Wait, let's do the math on that. We aren't talking about pirating one movie. These AI models are trained on data sets containing hundreds of millions, sometimes billions, of individual works.
Let's run a highly conservative hypothetical. Imagine a court rules that Meta infringed on the copyrights of just 1 million books during the training of an AI model. If the judge applies a maximum statutory penalty of $150,000 per book, the calculated liability is $150 billion.
$150 billion. That would instantly wipe out years of profit. It would absolutely cripple the balance sheet.
The liability does not scale linearly, it goes vertical. The math of statutory damages applied to the scale of global data scraping produces numbers that theoretically exceed the total market capitalization of the companies involved. This is why the financial risk associated with generative AI copyright litigation remains an entirely unquantified, apocalyptic, black swan event for the tech industry.
Wow. When you are staring down the barrel of potentially uncapped $100 billion statutory damages while simultaneously trying to fund $20 billion a quarter in physical infrastructure, suddenly every single dollar of cash flow matters immensely.
Every penny counts.
You have to aggressively protect your margins. Which brings us to the final piece of the puzzle: how Meta navigates the labyrinth of global taxation and financial maneuvering to shield their massive profits.
This section of the deep dive requires us to really look at the sheer accounting acrobatics detailed in the filing. Because what Meta achieves in the tax code is just as complex as what they achieve in their AI algorithms.
I was reading the section on their provision for income taxes, and my brain legitimately short-circuited. For the first quarter of 2026, their effective tax rate was negative 23%. Not a 23% tax rate, negative 23.
It looks like an error, doesn't it?
How is it mathematically possible for a corporation that generated nearly $27 billion in pure profit to report a negative tax rate to the federal government?
It sounds like a typo, but it is the result of a very specific and highly lucrative collision of tax legislation. To understand it, we have to look at the history of how the U.S. government taxes research and development. Historically, companies could deduct their R&D expenses from their taxes in the exact same year they spent the money. It was a massive incentive to innovate.
Right.
However, recent changes to the tax code altered that. Companies were suddenly forced to capitalize and amortize their R&D costs.
Meaning, if they spend $1 billion researching a new VR headset, they can't take the full $1 billion tax deduction this year. They have to spread it out, claiming maybe $200 million a year for 5 years.
Exactly. This change significantly increased the immediate tax burden for tech companies that spend heavily on research. It pushed many of them into higher brackets, subjecting them to the Corporate Alternative Minimum Tax, or CAMT.
The CMT.
Yes. However, the 10Q highlights a massive reversal of fortune. On February 18, 2026, the U.S. Treasury Department issued Notice 2026-7. This notice provided specific transitional relief regarding how companies calculate their CAMT liability in relation to those amortized R&D costs.
So the government changed the rules back, or at least provided a massive loophole.
They provided a massive adjustment mechanism.
Yeah.
And because Meta spends billions upon billions on R&D for Reality Labs and AI, this technical adjustment resulted in an enormous windfall. The filing states that as a direct result of Treasury Notice 2026-7, Meta recognized an $8.03 billion discrete income tax benefit in the first quarter of 2026.
$8 billion. It is the ultimate corporate tax coupon. They found an $8 billion credit hidden in the bureaucratic minutia of a Treasury notice.
Basically, yes.
That single credit was so large that it completely wiped out their entire expected tax burden for the quarter and pushed their effective tax rate down to negative 23%. If you remove that specific one-time benefit, the filing notes their baseline effective tax rate would have been 14%, which is still incredibly low for a company of this scale, but at least it's a positive number.
However, while their tax accountants managed a miraculous victory with the CAMT relief, they are simultaneously locked in a titanic, decade-long war with the Internal Revenue Service over historical taxes. The filing details a massive dispute regarding a concept called transfer pricing.
The 10Q states they received a statutory notice of deficiency from the IRS for the tax years 2017 through 2019. The IRS is demanding $15.89 billion in additional taxes and penalties.
Almost $16 billion.
This raises an important question, though. How does a company accidentally underpay their taxes by almost $16 billion over a 3-year period?
Well, it isn't an accident. It is a fundamental disagreement over the valuation of intangible assets in a globalized economy. Transfer pricing is the complex accounting mechanism that multinational corporations use to allocate profits among their various global subsidiaries. It is the heart of strategies historically known as the double Irish.
I need you to walk me through the mechanics of how this actually works. Let's use a hypothetical example.
Okay, let's say a team of brilliant Meta software engineers working at headquarters in Menlo Park, California, writes a revolutionary new algorithm for targeting ads. That code is intellectual property, is incredibly valuable, but it is entirely intangible.
Right, you can't touch it.
Meta US can then legally transfer or license the rights to utilize that specific intellectual property to their foreign subsidiary, Meta Ireland.
And they do this because Ireland has a vastly lower corporate tax rate than the United States.
Correct. Meta Ireland then utilizes that brilliant algorithm to sell advertising across all of Europe, the Middle East, and Africa, generating tens of billions of dollars in revenue. That massive revenue is now sitting in Ireland, subject to the lower Irish tax rate.
But the U.S. government isn't just going to let them invent the valuable thing in California and shift all the profits to Dublin for free, right?
Exactly. U.S. tax law requires that when Meta US transfers that IP to Meta Ireland, it must be an arm's-length transaction, meaning Meta Ireland has to pay Meta US a fair market royalty for the right to use the algorithm, just as if they were two entirely unrelated companies. This royalty payment flows back to the United States, where it is taxed at the higher U.S. corporate rate.
So the entire game comes down to how you value the algorithm. If Meta's accountants argue that the algorithm isn't actually that special and they value the IP very low, then Meta Ireland only has to pay a tiny royalty back to the U.S.,
Yes.
allowing them to keep the lion's share of the billions of dollars in profit safely sheltered in the low-tax jurisdiction of Ireland.
You have perfectly described the friction point. The IRS's entire job in this scenario is to audit that transaction and argue the opposite. The IRS looks at the billions in European revenue and says, that algorithm was incredibly valuable, you vastly underpriced the IP transfer. Meta Ireland should have paid a massive multi-billion-dollar royalty back to Meta US, which we would have taxed.
And because valuing an intangible line of code is highly subjective, it turns into a multi-billion-dollar legal war. The filing actually details a previous battle over this exact issue. It mentions a court opinion regarding the 2010 tax year, where a judge ruled that the value of the IP Meta transferred to a foreign subsidiary was $7.79 billion. That was $1.48 billion higher than what Meta originally claimed it was worth on their tax returns.
Meta lost that specific valuation argument for 2010 and had to adjust their tax payments. Now, the IRS is taking the aggressive valuation methodology established in that 2010 court ruling and applying it forcefully to the vastly larger revenue years of 2017, 2018, and 2019. That extrapolation is how they arrived at the staggering demand for $15.89 billion in back taxes and penalties.
Meta is obviously not just going to write a check for $16 billion.
They are fiercely contesting it in U.S. tax court. They argue that the IRS's proposed adjustments are deeply flawed because they fail to take into account other correlative offsets, deductions, and the complex reality of how global IP is actually developed and utilized. However, the risk is so substantial that the 10Q notes Meta currently carries a gross unrecognized tax benefit liability of $17.82 billion on their balance sheet. That is a massive, dark cloud of financial uncertainty hovering directly over their future cash flows.
But even with that dark cloud, even with the $19 billion in quarterly capital expenditures, the potentially uncapped copyright liabilities, the multi-billion-dollar Reality Labs furnace, and a $16 billion dispute with the IRS, even with all of that, the core advertising engine of this company is so obscenely powerful that they still managed to casually pay out $1.35 billion in cash dividends to their shareholders this quarter.
It's unbelievable resilience.
They are operating amidst unimaginable structural friction, yet they remain a geyser of capital.
Which brings us back to the premise we established at the beginning of this conversation. This document is not a dry spreadsheet. It is a testament to the sheer brute force of scale in the digital age.
We have covered a tremendous amount of incredibly dense material today. We've dissected the mechanics of how Meta's AI targeting circumvents privacy laws to extract 12% more revenue from every ad impression. We've mapped out their mind-bending $237 billion commitments to secure the hardware for an AI-driven future, including the complex off-balance sheet maneuvers of their Louisiana data centers.
The physical buildup.
We've analyzed the deliberate, decadal philosophy behind burning $4 billion a quarter to invent frictionless augmented reality glasses. And we've surveyed the existential, structural threats they face from governments attempting to rewrite their algorithms and copyright lawsuits threatening their generative AI ambitions. So what does this all mean? When you step back and look at the totality of this 10Q, what is the grand takeaway?
If we pull all of these disparate threads together, the CapEx, the VIEs, the legal maneuvers, it forces us to fundamentally reevaluate our baseline understanding of what this corporation actually is.
How so?
For the last 2 decades, the global public, and even Wall Street, has conceptualized Meta as a software company. We think of them as an icon on our smartphone screen. They provide a digital ethereal space where we share photographs, message our families, and consume media. They were a company composed of code, living weightlessly in the cloud. But look closely at the numbers we just unpacked.
Right, look at the physical footprint.
Look at the $182 billion in uncommenced physical real estate leases. Look at the $27 billion concrete and steel data center campus in Louisiana. Look at a workforce that is only growing by 1%, while capital expenditures approach $20 billion every 90 days.
They aren't just writing software anymore. They are buying land, raw materials, heavy machinery, and electrical capacity.
Exactly. The final provocative thought to leave you with is this. Is it possible that Meta is quietly, aggressively transforming from a consumer social media software company into one of the world's largest, most dominant physical utilities?
Wow.
If the consensus is correct, and the future of the global economy truly runs on artificial intelligence, the ultimate untouchable monopoly might not be the AI software algorithm itself. Software can eventually be copied, reverse engineered, or open sourced by competitors. The true monopoly of the next century might be the concrete walls of the data centers, the massive industrial liquid cooling systems, and the literal contracted gigawatts of electrical grid power that Meta is quietly locking up in non-cancelable leases through the year 2036.
They realize that whoever controls the physical power plant required to run the internet, well, they control the internet itself. And they are using the billions generated by our daily attention to buy up the global supply chain of computing power before anyone else even realizes the race has shifted from software to hardware.
It is a profound pivot from dominating digital space to conquering physical reality. And the entire blueprint for that conquest is hidden right here in the plain sight of the financial footnotes.
That is an incredibly heavy, fascinating thought to end on. Thank you to the listener for joining us on this deep dive into the source material. We hope this conversation helped you see past the clinical spreadsheets and the corporate jargon to understand the massive, invisible mechanisms that are actively shaping both our digital experiences and our physical infrastructure. Stay curious, keep reading the fine print, and always keep questioning the systems that are quietly running our world.